Hello everyone, I am Mohak. Today I will talk about joint work with Jeff Ramsey, and Jeff is here with us today. Privacy is an important topic in decentralized finance, and there has been a lot of advancement with cryptographic techniques and trusted execution environments. However, these techniques do not help us with constant function market makers. And this is because of the way the CFMMs operate, and that is the topic of this work. So what are market makers? Market makers are participants who code both bits and Rs, and they provide liquidity to the market. They take a risk, and in return for that risk, they charge a bid-ask spread. Now, how do CFMMs work? So a CFMM is defined by a trading function. The trading function has to be convex and non-decreasing in both assets. And a trading rule is that any trade is acceptable to a CFMM as long as the state after the trade is at least as much as before the trade on the level curve. An important quantity with respect to the CFMMs which we need for this work is the spot price. The spot price informally is the price that the CFMM quotes for a small trade. Mathematically, it is given by the slope of the CFMM's trading function at a given point. Now, this clean mathematical formulation implies that there is a bijection between the amount of asset X and the spot price on the CFMM for a given level curve. Now, this can be problematic. So let us say that an adversary or an attacker knows the level curve, and they they query the spot price at multiple points. Then they will exactly know what were the trade sizes between these spot prices. So this is the main problem that we are going to talk about in this work. And there's another problem with CFMMs which is well known by now, and it has been solved with trading fees, and that is the problem of arbitrage. So the CFMM spot price, let's say it's P at a given point of time, and the true market price is P prime. If P prime is greater than P, then an arbitrager can buy some X from the CFMM and sell it to the external market for a risk-free profit. So how can an attacker finally make a privacy attack? So let's say we have a trader Todd who wants to make a private trade on the CFMM. Now we can hide their account balances using cryptographic techniques, and we can also probably hide the CFMM's pool size using similar techniques. However, just by the economic mechanism of the CFMMs, the trade size can still be inferred. For this, the attacker will only need to know the trading function, and when the trade is happening, they need to query the spot price, and they also need to query whether a given non-zero trade is feasible or not. If they can make these queries at multiple times before and after the trader Todd's trade, then they can, as previous work shows, they can exactly infer the size of the trade, regardless of what cryptographic techniques have been used to hide the balances. So can CFMMs be made private at all? This problem has been studied by previous work, and Angeris, Evans, and Chitra showed that two possibilities are to add noises to every trade, and the other possibility is to batch the trades, and so that we can mask the exact trade amounts of individual trades. And there has been work on this problem in the prediction markets literature as well. In the first talk of the session, we saw that the results from the prediction markets literature, which use a cost function based market makers, can be applied directly to CFMMs. In that literature, the main result was that in a noise adding privacy mechanism, without a privacy fees, the market maker may incur unbounded losses. So in this work, we are going to restrict ourselves to these noise adding privacy mechanisms, and our focus is to understand what this fees has to be so that the CFMM can be compensated for these additional losses. By additional, I mean that the CFMM, just by its basic operation, is subject to arbitrage losses, but because of this privacy feature, it will be subject to additional losses, and that is what we want to compensate them for. So this is an overview of this talk. We will adopt the mechanism of injecting noise traits into the CFMM state. And to model the privacy of the traders, we will use a framework called personalized local differential privacy. Differential privacy is a well-known framework for hiding data points in a database. And by local here, we mean that each trader's trade is hidden separately and not as a part of a batch. And by personalization, we mean that different traders may have different privacy requirements. Some traders may want to use traditional CFMM in which they do not want to pay any additional privacy fees and they do not want to hide their trade. However, other traders may want a significant amount of privacy. So in this work, we gave a framework in which users can specify their privacy level, and we will compute a personalized privacy fees. So we show that this privacy feature leads to additional losses to the CFMM. Now the question is that without querying the true price, without having an oracle for the true price, is it even possible to price these additional losses? That is not obvious. So that is the main question that we answer here. That first we start with a negative result, that if we have non-zero mean noise distributions, then it is not possible to price the privacy feature without knowing the true price on the external exchange. However, if we adopt zero mean noise distributions, then it is possible to find a privacy fees which in expectation matches this maximum possible additional arbitrage loss. And then we show that this privacy fees is inversely proportional to the liquidity, and this ties the privacy fees problem back to the original problem of designing a CFM curve. So coming back to our model of privacy, so there are a lot of terms in this definition. Personalized local differential privacy. As I mentioned earlier, differential privacy is basically just to, in the context of databases, to quantify the amount of privacy loss if only one data point is changed in a database and the adversary is able to query both these databases. By local, we mean that every data point is hidden before sending it to the database. In this case, it is perturbed before sending it to the CFMM. And by personalized, we mean that every user gets to specify how much privacy they want. And this is how they specify the amount of privacy that they want. They can specify a region in which they want to mask their trade. This region will be, let us say if they want to trade 10 units of X, they can say that I want to mask it between 5 and 15. So an attacker can definitely know that it is not outside 5 and 15, but exactly where between this interval is where the privacy guarantees are. And then they can also specify a level of privacy, that is within this interval, how well is it hidden. An epsilon of 0 will correspond to the maximum possible uniform privacy in this interval, and higher epsilon will mean lower privacy. So we can use this definition in the traditional differential privacy framework, and there the intuition is that the information that an adversary can learn about your data point should be bounded by the exponential of epsilon I. So there has been previous work on bounding the losses of the market maker in the case of private CFMMs and private prediction markets. In the case of prediction markets, Frangelo and Wagner gave a mechanism in which they charge a constant privacy fees to everyone, and under some assumptions on the boundedness of the trade sizes, they can give the same privacy guarantee for everyone, and they show that the loss of the market maker will be also bounded. In another work in DeFi, Chitra, Angeris, and Evans show that we can split and shuffle trades in a block to achieve the same privacy guarantees for all users. So with respect to these works, our novelty is that we give personalization to the privacy requirements, and also we calculate the exact amount of fees which will compensate the LPs against the additional arbitrage loss. This is messed up. The animations are gone. I will try to walk you through this. So let us say we have a trader who is interacting with a CFMM. So there is a trader who is interacting with the CFMM. In a traditional CFMM, they will just send a delta X unit of fees, delta X units of the trade, and they will get back delta Y units. Whereas in our mechanism, we will introduce a noise trade module wherein the trader will now send an additional fees. And what this noise rate module will do is that it will draw a noise eta and add that to delta x before sending it to the CFMM. Now the CFM will observe only delta x plus eta, and any attacker who is querying the CFMM will only be able to see delta x plus eta, thereby hiding the trader's trade. One important question here is, how do we implement such a trusted noise trade module? Well, this is something which we don't have a clear answer to yet. We will leave this to the evolving literature on private smart contracts, for example, Hawk. In this work, we will focus on the economic implications of such a noise trade module, assuming that we can do this in a trusted fashion. So coming back to understanding the mechanism of this additional arbitrage loss. So same as the previous example of traditional CFMM, let us say there is a spot price P and the true price is P prime greater than P. There's a trader who will buy X from the CFMM such that the post-trade spot price becomes P prime, and this is the optimal trade to extract the maximum amount of arbitrage. However, after the CFMM draws on a noise trade to mask the trade, the CFMM spot price will again become different from P prime. Now the trader gets another opportunity to do an arbitrage trade. So if there is insufficient amount of fees that is charged for the privacy feature, then the trader can do this indefinitely and they can continue to extract money from the CFMM. So what do we do about it? So first we define some properties that we desire from this mechanism. So the first property is priceability. So this is to say that without querying an oracle on the true price, is it even possible to define a finite privacy fees such that it matches the maximum possible additional arbitrage in expectation? So this definition is to see whether we can even implement a privacy mechanism without making losses to the CFMM. Another property is that as with traditional CFMMs, we want the spot price of the CFMM to be consistent with the external market price. That is, if we have arbitrages in the market whose main function is to make these prices equal, they must continue to use their existing techniques to set the correct price on the CFMM without worrying about the privacy feature. So this is the traditional notion of a truthfulness in a CFMM. Interesting observations are that these two seemingly unrelated properties are actually go hand in hand. So truthfulness implies priceability. This means that if an arbitrager does not care about the privacy feature, that means that we have set the right fees for the privacy feature, and in expectation there is no gain to be made by gaming this privacy feature. And also, if a CFMM is priceable, then there does exist a privacy fees under which the CFM also becomes truthful. So coming back to our first result, we show that if the noise state distribution is not zero mean, then the noisy CFMM is not priceable. That is, we can always come up with scenarios in which the arbitrager can extract more money than the finite privacy fees that we have set, if the noise state distribution is not zero mean. So this is how this works. An arbitrager can perform a series of trades such that in the arbitrage region of prices between P and P prime, they can draw a lot of noise trades, and this will informally increase the liquidity in this arbitrage region of the prices. One implication of this result is that one naive implementation of completely masking the trades by setting the noise trade equal to negative of the original trade is not a viable option, because it will lead to unbounded losses for the market maker. The good news is that if we use zero mean noise distributions, then our mechanism is priceable, and we can formulate the right privacy fees by this formula. And The formula is a function of x tilde. X tilde is the state of the CFMM before this trade. Delta tilde is the trade amount, and the distribution D captures the privacy specifications of the trader. So the proof sketch is as follows. We can decompose every trade into two parts. One part will correspond to the original arbitrage problem of the traditional CFMM, and the other part is the extra, which is intended to capture the additional arbitrage. If the privacy fees is tau, then we can show that for every extra trade, the privacy fees matches the additional arbitrage profit and expectation. And using Dup's optional stopping theorem on martingales, we can show that as long as the adversary is restricted to make only a bounded sequence of trades, they cannot beat the expectation by any strategy of playing around with different trade sequences. So far we have seen some theoretical results on how to set this right fees. But if I tell you that if this fees turns out to be 10% for a small trade, then that is not acceptable. So here we see a numerical example on how much this fees ends up being. So for this example, we will use the binary noise distribution, which is a common choice in the differential privacy literature for the high privacy regime. And we will use the most popular CFMM, which is the constant product rule used by Uniswap. In this example, let us say the initial state of the CFMM is 100 units of X and 100 units of Y, and a trader wants to buy 1 unit of X. Their privacy specifications are the interval 0 to 2 and epsilon is equals to 2, which is a moderate amount of privacy by most standards. In this case, the privacy fees is about 1.7%, which is not too much. And if we have a deeper pool, then the privacy fees is even smaller. In fact, we can show that the privacy fees scales inversely proportionally with the liquidity of the CFMM. So if you go back to the problem of designing the CFMM trading curve and allocating liquidity, then the privacy mechanism can be a new dimension to think about in that problem of allocating liquidity. So in this work, we studied a standalone CFMM, and we studied how we can implement a privacy feature on it. However, this can also have unintended consequences. For example, if some other program is using the CFMM for a price oracle, then injecting these noise traits can increase the volatility in the prices, and it can have some other consequences which we need to study in future work. Also, another interesting challenge is to actually deploy this and have trusted mechanisms to have the noise fees mechanism, and that is a work which needs more innovations in the private smart contract space. So thank you so much, and I'm happy to take questions.
So I might miss something in the talk. So all the time you are talking about the user is getting some additional utility and they are making them pay this additional fee, which is to compensate the market for the losses, right? But it could be the case that it is the other way around. Because of this noise that I'm adding to my trade, I'm ending up paying higher price than I'm supposed to, which means that the market is making additional profits now. Do you compensate me for that, or yeah, is this even an issue, or it is not an issue under your model?
So the trader gets to get exactly as many units that they would get in the non-private mechanism. So in this case, we can see that delta y does not change, but the additional trade which comes from the noise, that is made by the noise trade module, which is a separate account which needs to be hidden in some way. So for the purpose of the trader, they just need to pay an extra fees, and they do not need to change the amount of Y that they get from the market.
But the price will be a little bit different when you are doing the matching, no?
Yeah, so like if we include this fees into the price calculation, then it is a bit higher, yes.
Okay. Yeah, I will bug you more about it offline. Thank you.
Of course.
Would the total noise trade fee correlate with trade size?
Yes.
Why?
So if you are making a larger trade, then you need a larger amount of noise to hide it.
Is that linear in the same way that the actual trade fee is, or is it like more of a logarithmic relationship? And at a certain point, like a certain amount of noise is good enough.
So it's not linear. So it comes from this formula, and this delta tilde is the noise trade size, and P is you can think of P as the liquidity in that region. So yeah, so it's not linear, but it increases with the trade size.
Okay, got it. Thanks. Thank all the speakers.